Woo! Welcome back to another episode of The Educated Homebuyer with my esteemed colleague here, Josh Lewis. We are here to answer your questions about housing, about mortgage, while we update you on the economy. Josh, I was gone last week, so it's good to be back, but good to see you here on the intrawebs.
I first you said esteemed. I realized you said esteemed colleague. I thought you said your steamed colleague, and I am a little irritated today. So thought you were making a little comment on that.
Josh came into the office this morning, mind you, 4 hours late. I mean, for most people's normal working day, and just looked PO'd, like didn't want to talk to anyone, just bad mood. So it's good to see a smile on Josh's face.
Yeah, no, this has been a chaotic day. So you went to North Carolina last week. After you left, I flew off to Indianapolis and then came back. And so I missed the first 2 days this week. And today was just chaos, not fun at all.
Well, it's good to be back. Happening in the economy. We've got some updates this morning, since our I guess last week I wasn't here, but we've had essentially a war breakout, and we've had some things come out from the Fed with regards to statements that has led the market to believe that they might be done with rate hikes, becoming a little bit more restrictive, just leaving rates higher for a bit longer versus adding any additional volatility to the market. With that, we've seen the 10-year retrace. We've got some economic news kind of bouncing all over the place. Tomorrow we get CPI, which is probably the front runner for any sort of rate movement, at least for this week, on top of what's already going on. And I know we're going to talk about that here in more detail. Josh, anything you want to discuss before we jump into charts?
No, let's just go straight to the charts. It'll drag out anything we want to talk about, right?
There you go. Absolutely. So with that, we're going to start like we always do and take a look at inventory. It was about 2,000 homes nationwide, pretty minimal, to say the least. One of the analysts that we follow, his number is somewhere between 11 and 17,000 listings per week is what it would take in order to kind of get housing back to a more normal market. And he's been talking about that all year, and we haven't hit those numbers, I don't think, any weeks out of and now we're trending at 2,000, which leads us to probably believe that we're probably near the peak in inventory, real close if we haven't hit already. Orange County 2383 properties, Huntington Beach 197, so a little bit up week over week for Orange County, and about the same new listings coming to the market. More listings coming to the market, in theory, is what will settle some of the craziness out there. We need homes to sit on the market longer and build in order to slow the chaos, the chaos, if you will, of just that low inventory vibe that we've had for the last 2 years. And so what we've seen is inventory kind of go up, go down, whatever. And now new listings they're up a little bit, but more of what we're seeing is rates sitting at 23-year highs, not really coming off those highs, and less buyer demand in the market, which means homes that are on the market are sitting longer. And so that's what's causing that build in inventory, just less buyers going under contract. And as you can see here, unfortunately, the chart that we normally use isn't available anymore because Housing Wire decided to rebrand the Altos chart and make it all the colors exactly the same color scheme, making it very difficult to actually see what the hell is going on here. But if you look at that darker red towards the bottom, that's active new listings coming to the uptick, but still below where we were this time last year. Barely, but still below. National single family inventory. So this chart is also one that we normally look at, but again, they rebranded it, shortened the length. It used to go back to like 2015. Now it's only going back to 2019, but just kind of shows historical inventory, where we are versus where we've been in years past. And you can see, we're still below where we were this time last year, and probably going to peak here, I would think, really, really soon, just because of seasonality. Pending home sales, 327 total versus 359 this time last year. So a little bit less than we were this time last year. But this year we got 58 58,000 new pendings versus 53,000 pending last year. So more homes pending this year than we did last, but the total number is actually a little bit less than it was last. I'll look at the median price of single family homes in contracts. We're at 374. This time last year, we were at 364. So the price of a home currently under contract is a little bit higher than it was last year. But I mean, at the end of the day, $10,000, more or less the same. So this is that week over week change that we talked about, going from 534 to 537, just less than 2,000 homes. Our peak this year, we're currently sitting at it at 537. We still haven't peaked quite yet. And then this time back in 2015, we were sitting at 1,168,000 homes. So considerably less than where we are right now. And then the number of homes going under contract, being reduced is sitting at 37.5%. Still, we're below where we were last year, this time sitting at 42%. But I would imagine, Josh, this number is going to continue to increase as rates stay higher. And then here we go. A look at a function of what on this chart.
So yeah, you're just looking at a number of things. GDP, long-term trend decreasing. Inflation, long-term trend decreasing. So even if you look, the blue line there is inflation, and we look at it over to the right, we go, oh my God, the last couple of years inflation was so high. But again, you look at what was really high in that chart, we never got anywhere near it. Doesn't mean it's not painful, doesn't mean it's not problematic. It absolutely is and was, but definitely normalizing. So when you look there, the only thing that hasn't come along for the ride at the end is the 10-year treasury, in that it just continues going up. So when you look at that, you're seeing that the long-term trend should be and is for all of those to continue lower. So kind of Jeb feeds into our conversation here of what is going on with interest rates. We've seen a little bit of recovery over the last couple of days here. But here, the comment on this chart is that the debt is one of the primary reasons why economic growth will continue to run at lower levels. Changes in structural employment, demographics, and deflationary pressures derived from changes in productivity will magnify these problems. So again, that trend line, lower growth, lower inflation, lower interest rates should come along for the ride. This chart basically tells us, what have people been worrying about? What is the big fear that gripped the markets over the last 4 to 6 weeks that took the 10-year treasury from 4 up to 480 kind of at the worst? This says, as of the latest annual data through the end of Q2 2023, the government spent $6.3 trillion, of which $5.3 trillion went to mandatory expenses. So in other words, currently requires 113% of every dollar of revenue to pay for social welfare, so Medicare, Social Security, and interest on the debt. And we've already seen, and we're going to see here, I think I threw the chart in here, that debt keeps increasing. So everything else must come from additional debt issuance. So that is what the market is looking at. And on top of that, you guys have probably seen in the headlines over the last few weeks, this idea of the term premium is increasing. What does that mean, the term premium? Well, we always kind of know when you have a normal yield curve, a 2-year treasury is going to yield less than a 10-year treasury is going to yield less than a 30-year treasury, because you are giving up your money for a shorter period of time. You're without your money for a shorter period of time. And what that term premium is, it's a reward for the uncertainty of what could happen over that timeline. So when we've seen, we talked about over the last 40 years, interest rates really only went one direction and went down. So over that 40 years, bond market buyers said, I don't have a whole lot of risk in tying up my money because I'm locking in today's yield. The yield's likely to be lower over the long haul. If I want to sell that treasury, I'll make a little bit of money on it. So that is what I believe has been repriced over the last few weeks. It's a valid thought, a valid concern when the government is spending far more than they're bringing in. And if you saw, we had yet the 9,000th debate about whether we're going to shut down the government. And the media's take on it was that was being an obstructionist versus saying, hey, continuing to fund the government that spends too much money is problematic over the long haul. So that chart just again is a different look at overspending.
Yeah, I mean, I had a conversation with financial planner last week or 2 weeks ago, and one of the conversations we had was talking about, where we are right now with federal debt, $33 trillion. and where we're expected to be by 2030. I think it's supposed to peak somewhere, or not peak, but hit somewhere around $45 trillion is the number, which, he basically said that, based on demographics and where we are with Social Security and pension funds, that I think it's within the next 2 years that the government essentially doesn't have enough money to even fund those programs. And so we'll be spending more on government debt, on just the interest payments alone, more than we spend on Social Security, the defense budget, and one other thing. I can't remember what it was, but I mean, we got big problems here.
Chart here shows the payments on that debt. Everyone talks about, hey, there's this much debt, but the dark blue line on that trend, there's a red line, the dashed line, and then that dark blue line there shows the Congressional Budget Office's estimate of interest expense going forward. Well, the better estimate is that red line of what it's looking. That's Goldman Sachs estimate. They had a prior estimate as that dash line, and they've raised that to the high end. So we know that barring Treasury rates going down, not like immediately, but fairly soon, at some point next year, it's a problem now and going to become a bigger problem going forward. So this chart here, Jeb, gives us some hope here. This is treasuries being overbought or oversold. Oversold means people are selling at whatever price, and that pushes yields higher. Prices lower on bonds in terms of the 10-year treasury, pushing yields higher. So we hit a level here that every time has been a reversal, has shown a reversal, been indicative of a reversal. And we've seen that the first few days this week, but 2 days doesn't make a trend. We need a few weeks of this, and preferably a couple of months. Not that we're going to expect a straight line. A slow grind better, like we've seen a consistent and slow grind worse over the last 3 to 4 months. This is an interesting chart here, Jeb, keeping on the topic of the 10-year treasury. If you look, those two lines were very tightly correlated. It's the 10-year treasury and the ISM manufacturing index. Well, the ISM manufacturing index has taken a big turn down, and yet the 10-year has continued to go up. So we would expect over the long haul that correlation is going to hold up, which means either 10-year treasuries have to come down or ISM manufacturing needs to increase. Anytime you have a single data point like this, be careful. Just because something's been tightly correlated in the past doesn't mean they don't become decoupled, but it's another data point that we're looking at that tells us that 10 years are probably yielding a little bit more than they should. The fear is probably slightly overblown. This one here I thought was really interesting, Jeb. When we exclude autos and transportation equipment, private sector demand has been historically weak. This is real private final sales when you exclude autos and transport equipment. So it's already negative. Like, we keep hearing about how strong the economy is, and the Fed needs to keep higher for longer. We might have to raise again, and we're just not seeing it in the data. So this was important. If we look the last 3 days. So remember, we had the Columbus Day holiday on Monday, or Indigenous People Day,
Josh.
That's only in California.
So insensitive.
That's only in California. Federally, it's still Columbus Day. So with that, bonds did not trade. So what happened? Last Friday, you had war breakout in the Middle East. And with that, no matter where war breaks out, you generally see a flight to safety. That's uncertainty. People come out of stocks and into bonds. Mm-hmm. So what did we see? Monday, because of the holiday, the markets were closed, but the futures trading indicated that we were going to open Tuesday with much lower yields, which we did. Mm-hmm. And then we saw follow through today, despite, we'll go through the PPI numbers here in a second, Jeb. Strong PPI numbers, a big beat on that. Actually, market just continued rallying. So normally what you see when it's a flight to safety, money will come out of stocks and into bonds. Both of them did very well yesterday. Yep. I didn't see where stocks were today. I don't think they did as well today, but yesterday both performed really well. So it leads us to look at what else happened. So starting yesterday, and I don't believe any of them were out Monday, but yesterday and today, a lot of Fed speak. So Fed Governor Chris Waller says now, once again, financial markets are tightening up. Comparing the run-up in treasuries to the bank stress events from March, which we had seen yields drop at that point. Fed Chair Logan says higher yields may mean less need to raise rates. Bostic says, I don't think we need to increase rates anymore. Economy is clearly slowing, lots of impact yet to come. And Daly says rise in bond yields build a case for a Fed hold. So These guys don't go out like renegades just on their own saying whatever they want. This is coordinated. When you see 5, 6, 7 of them out over the course of a couple of days saying that we've probably seen the end of hikes. Also important here, Jeb, for everyone to note, this does not mean that they're going to start cutting next week, next month, or even early next year. It means that they have finally convinced themselves that they can sit back and see what happens next. So with this is futures trading, Jeb. I actually colored up this pretty little chart that we both looked at earlier today. The actual chart is all white except for the yellow, the light yellow at the bottom and the light blue through the middle. So the light blue shows you what the greatest probability is at each of the next meetings. So in November, basically 88% chance the Fed does nothing. In December, 75% chance the Fed does nothing. In January, 72% chance they do nothing. But the next greatest probability is that they hike with almost no chance that they cut. So we're looking at greatest probability of nothing happening over the next 3 meetings. But if something happens, it's likely to be a hike. Well, that shifts over starting next March. Still 57% chance they do nothing. In May, 41% chance they do nothing. But the greatest probability besides doing nothing is a cut. So the market is starting to say, hey, for the next 5 meetings, all the way throughout May of next year, we believe the greatest likelihood is that they do nothing. But if they do something, after the first of the year, it starts erring towards cuts. So if we look at that, I thought that was interesting. And by the time we get to next year, Jeb, December of 2024, a little bit more than a year away, we have a market's pricing in a 51% chance of Fed funds being 1% to 1.25% lower than where it is today. So it's just, we've seen some really confusing market action over the last 4 to 6 weeks, because if you look at this is kind of what I would expect. Holding here, not a whole lot of movement, but the next move lower, when it does come, should be lower.
Yeah, but with that, Josh, let's talk about the idea that of spreads within the 10-year treasury versus a 30-year fix. Just because the Fed funds comes down doesn't necessarily mean the spread improves, right? So one of the things I was reading yesterday or maybe the day before is that you just basically have a lack of bonds being purchased at the moment, right? So the Fed has been the biggest buyer of bonds for the longest period of time, and now they're letting them run off the balance sheet. So how does a cut in the Fed funds rate, does that bring interest rates down directly, or how does it affect that spread?
Absolutely not directly. We've talked about this before. When the Fed is hiking, the Fed doesn't directly control interest rates. It's more of sort of a compass as to where the market thinks inflation is going. When they undergo a hiking cycle, it says to the market that, hey, we think inflation is out of control and going to be eroding the purchasing power of dollars going forward. So you need a greater rate of return on your bond investments. And then when we get to the other side and you see cutting, that is the Fed saying, hey, we want to be a little stimulative or more stimulative or less restrictive than we have been. So as they pull their foot off the brake, yields in treasuries across the board should come down, and they should probably front run it. What have we talked about here a million times, Jeb? Some of the reason why we've had this really hawkish talk from the Fed all year is they do not want the market thinking they're going to take their foot off the brake. They want the market thinking that they're going to stay higher for longer, even if they don't believe they are. I'm not saying that they don't necessarily believe that they are, but even if they didn't, they don't want to signal that to the market because the market will front run that. Once we start seeing this and you start seeing other measures coming down, if you see GDP projections down under 2% in the first quarter of next year, second quarter of next year, you see obvious measures that we are slowing and that the Fed is likely to cut sooner rather than later. And we're not even talking about, Jeb, the big thing you hear is, hey, the Fed's going to keep tightening with the bank failures, but they were pretty well contained, only a handful of them. But there's still the possibility, if not probability, that something does break and they will be forced to step in and cut sooner rather than later. I had a couple charts here.
I hope it happens tomorrow.
That's just because you're in the market right now, Jeb.
That's too funny.
So we talked about PPI. We had this big spike in PPI through 21 and 22. Pretty much has worked its way out of the market. If you see where we're at, pretty similar from, where we were 2017 through 2019 prior to COVID, the 2 years before. So all of that basically in line. What we saw today, Jeb, if you're a conspiracy theorist at home, for some reason, the the government, when they compiled these numbers, had some really strong upward revisions to the last couple of months. So the month over month was a 0.1% beat, but we saw 0.4 year over year because the numbers from the last 2 months were revised strongly upwards.
And just a quick reminder, if you're listening to this on audio, there's a link in the description of the video, actually on YouTube as well, where you can go see these charts. You can download them there in a Google Drive. You can take a look at them, do whatever you want to with them. I updated them after the video started, so you might have to refresh in order to do that. But Josh, PPI versus CPI, right? Just so people listening know what we're talking about. CPI is what a consumer is paying for whatever goods we're talking about, and PPI is what it's costing to produce that good. So what you're seeing on both sides is those numbers come down, which is ultimately deflationary. Expectations for tomorrow. We talked about this earlier, Josh. Yep.
Yeah, and remember, it's disinflationary, not deflationary. We have seen a few deflationary numbers. Deflationary means actually going down year over year. Disinflationary means we're not seeing those horrific high numbers any longer. So there are two numbers here for expectations for tomorrow. So the Cleveland Fed combines and compiles numbers. They are expecting 0.4 for year over year, and it replaces a 0.4 figure from last year. So no change. Expect it to hold steady at 3.7%. But the core number, which we talked about a million times here, that the Fed looks at more closely, it strips out food and energy. They're expecting a September number of 0.36, which will replace a 0.57 from last year and take the year over year change to 4.2 from 4.3%. So how does that vary with the market consensus? Basically, the market is expecting 0.3 on the headline, replacing a 0.4, so a drop from 3.7 to 3.6, and the core pretty much in line with what the Fed, Cleveland Fed, is expecting, and also they're hoping or thinking or expecting we'll see 4.1 versus a 4.3. If we hit these numbers, Jeb, it's likely to be a continuation of the little rally we've seen over the last couple of days. And look at it in the big picture; it's more of a correction. Our next technical resistance is at like 4.5 on the 10-year Treasury. If we ran all the way to 4.5, that would be a nice little bear market rally here, but it's not really indicative of a change. We would have to see a run through 4.5 and back down considerably lower. But if I were a betting man or a guessing man, I think we're going to get decent CPI figures tomorrow, probably a continuation. I think we're going to have a hard time working through 4.5. But look at this. I always ask consensus. Who's the consensus? Well, if you look, Morgan Stanley, Goldman Sachs, Citi, JP Morgan, Barclays, Bloomberg, BNP Paribas, Societe Generale, TD Securities, Scotiabank, UBS, Nomura, and Wells Fargo all agree that the number will be 3.6 tomorrow. So when someone tells you consensus, that's what we're looking at. This, I always like the chart just to give you the visual. So the core is the blue line, continues to go down. We saw that little spike up last month as energy prices increased. We had seen a nice correction, but the higher energy prices will still get picked up in the September data. It will be the October data before we see any correction, and that will also be dependent on what happens in the Middle East with oil prices.
It's probably not looking good, but
so just a quick look here, 10-year Treasury, that ugly, big, long red line is what got us to the really high rates. The last 2 days, we've seen a nice dip down. See the opposite view here. Mortgage-backed securities, when prices go down, rates go up. So this long ride down in prices. But we've seen a nice little reversal the last couple of days. We'll see how far this goes and if it truly is a trend reversal. There is the possibility when you have the Fed speakers out basically saying we don't need to hike anymore. We think things, meaning the market in general, that market consensus thinks there's more weakness in the economy than what the Fed thinks. So again, just a visual here that 450 is where we see the next level of resistance on our way down from that ceiling there at 491. What does that mean for you guys? Again, we trust the Mortgage News Daily numbers the best here. 30-year fixed, they were still at 7.6, but if you look, that's an October 10th number from yesterday. It was probably down around 7.5 today. FHA is probably back under 7. We can definitely get well-qualified borrowers under 7 on the government stuff. So just definitely better. It's good news, but you can't make too much of it until you see several weeks of this type of improvement.
No, yeah. I mean, you just got to do what's right for you, right? So I'm currently in the market, homes in escrow, buying another home. I'm looking at rates. Tomorrow will probably be, the day that I decide to lock or not lock. Just depend on what happened. I'm a little bit more of the guy who goes to Vegas and puts my money on the table and has fun. So Josh often talks about that guy. I'm willing to let things ride in order to kind of see what happens here. So I think there's a lot of volatility out in the market. I think the war, that's happening isn't likely to improve. And with that, I think the market's going to be a little bit more cautious personally. But again, it's all a guess. I mean, we've been quite guessing this entire time. So,
well, Jeb,
logical guesses. Yeah.
Weren't we looking at the headlines the other week that someone was predicting a black swan? And you're like, that's not a black swan, my friend. But the black swan, I don't think any of us, Israel was not expecting or thinking this was
is
coming.
It a black swan? I mean, it is. It's a black swan enough, but is it a black swan enough to crash a market? That's what I'm saying. Like that type of black swan is.
I'm not talking in terms of crashing a market, but in terms of an inflection point where a week ago, everyone was finally convinced that rates are going higher. We're going to have 8, 9, 10% mortgage rates.
I'm not convinced that they're not done going higher. I don't know. The data is still very, very strong in the market, even though it's become weaker. And, with that, I think that you don't see there's not a lot of room to go either direction, in my opinion. But what do I know? With that, we don't have a lot of questions in the chat. So if you guys have questions, put them in there. We'll do our best to answer them. There is 131 people watching. 32 of you have hit the like button, the thumbs up. If you haven't done so, do that. It helps out the channel, helps out the algorithm, pushes it to more people, helps us accomplish our goals here. With that, if you haven't checked out the Educated Homebuyer podcast, the YouTube channel, listen to us on Spotify, on Apple, do that. Rate us and review us if you like it. There's a lot of good information on there. In fact, this last week, we took Maria's recommendation here about assumable loans and did an episode on it. So a lot of that stuff comes from you guys. So if you have a topic you want us to cover, something you want us to go deeper on, let us know. That's what we're going to be talking about in more detail. Next week, we're actually going to be talking about the idea of, are you actually ever going to be able to afford a home? What needs to happen for you to be able to afford a home in this market? What do you need to focus on? We're going to kind of work it backwards, a little bit different take on the idea of it in order to help you guys become educated home buyers. So Josh, got a question here. That's a good question from Logical Thinker. It's something I read today. Just says, the National Association of Realtors and the Mortgage Bankers Association recently sent a letter to the Fed requesting that they stop raising rates. I sent one too, Josh. They didn't even, mine didn't get televised. Why do you think they sent this letter? So why would two organizations that are directly impacted by what's happening send a letter to the Fed? And what weight does that hold?
Logical Thinker's been here long enough and asked enough questions that I know they're not really asking the question. They're just throwing the information out there. The NAR and the MBA in this respect are not unique among any trade organization. Trade organizations are there to lobby the government for what will help their membership. So I saw this and I had two thoughts. I'm like, okay, I get it. The general thought here is the Fed has gone too far. They don't need to hike anymore. They can sit here and wait it out for 3 to 6 months and let the effects take hold. Some of the seasonality things slow down through the winter. It's not likely to increase economic activity, increase inflation through the next few months. That's not already in the pipeline. So when I look at that, it makes sense that they would say, hey, please stop doing this. You're making things very, very hard on not just our members and our industry. It's an important segment of the economy. We've talked about it before. It's not just, hey, we need people as they come of age into their late 20s, early 30s, start a family, leave home, earning good money. They want to buy a home. And increasingly, they either cannot qualify for it or choose not to because they're looking at a payment. They're going, that is astronomical. But I also step back and I say, from the Fed's perspective, if they truly believe this is the right thing and we have to do this to stop inflation and it puts a brick wall to the housing market, that's still the right thing to do. Is it painful? Yeah, it's painful. But that's sort of the flip side of the idiocy of what they did during COVID of keeping rates as low as long as they did and continuing buying bonds to do that. So from my perspective, I get it. I don't have a problem with them going on record with it. And hopefully it's just another voice saying, hey guys, chill out and just let's see what happens next. If we get hot reads, first part of the year and in spring and see inflation getting a toehold, I don't think that's the case. But if we did, then maybe they do need to hike more. But coming out and saying when we went from negative real interest rates, meaning you were getting a lower yield on treasuries than in the rate of inflation. So you weren't even keeping pace. Now we are strongly positive and inflation is coming down. So even without the Fed hiking anymore, real rates are getting more positive by the month. So more restrictive. It will continue doing that work for them as inflation continues to moderate. So from that perspective, why would they do it? Housing is important. It's very important. We hear from people on the podcast channel, reaching out in emails, making comments on the show, making comments on Jeb's channel. People saying the reason why we're doing the episode next week on the podcast of will I ever be able to buy a home? It's really to walk through that. We shouldn't have a generation of people sitting here questioning if it is ever going to happen for them. I will give a sneak preview of that episode of the podcast to just say it will. We've seen this before. We've seen periods of time where it looks bleak and young people are convinced
People
they're
have
never going to be
very
able
short
to do
memories on both sides of it, right? And they only seem to remember what's affecting them at the moment, and that's what gets televised, and that's what the headlines are. And it's unfortunate because, that creates other emotions and everything. And home buying is an emotional process. So again, we'll deep dive into it and you'll get some value out of it. So if you're not listening to the podcast, do so. Wesley asked a question about an ARM. Yes, I will be locking in an ARM more than likely. A 7-year is what I'm looking at, just because it's about 0.5% better than what I'm getting quoted on a 30-year. So we're looking at like 6.75 versus 7.375 on jumbo financing. That's a big difference, especially when you're financing, a decent amount. It's a big difference in your payment. And again, I'm under the belief that rates will have an opportunity to, they will come down. You'll have an opportunity to refinance, which is going to lead me actually into another question from Jeremy here, saying, where did his thing start? Let's see. He says, our first home loan was a VA and our second house was a traditional loan. Once my current build is complete, we have a construction loan. Would we be able to refinance the loan into a VA loan, Josh? So I'm assuming they no longer have the first home with a VA. But what are your thoughts?
That's the question. Either if the original loan was small enough that it didn't use up your entire entitlement and you have enough entitlement left to do the refinance, that would be one route towards it. But as Jeb pointed out, if the home that you owned with VA financing, if you sold that would also restore your entitlement and then enable you to do a VA refinance. There is one more option, which is a one-time restoration. So let's say you still own that property, you can refinance that to a conventional loan and you can restore your eligibility, but you can only do that once. So you always want to be very, very careful with that. But what I think we're understanding here is you no longer own that property. You should have had your entitlement restored and you can absolutely refinance that into a VA loan.
And then he goes on to ask about VA loans typically being lower rates. So I think that's, something to address here.
Government loans, FHA and VA, are always going to be lower than conventional loans. Historically, that was not the case because of the low down payment and the ability to go to lower credit scores. The bond market kind of looked at it and said, hey, those are higher risk. We want a higher yield. But post 2008, bond buyers looked at it and said, wait, Fannie and Freddie have an implied government guarantee. FHA, VA, USDA have real government guarantees. So if you believe in U.S. Treasuries, the next best thing is mortgage-backed securities backed by the government. So in general, at any given time, you're looking about 0.5% lower on FHA and VA. The big benefit with the VA is that you don't have monthly mortgage insurance. You will have a VA funding fee unless you have a service-related disability or other exemption.
And he does have one more question, but I'm not going to make this the Jeremy show, so we'll come back. It was actually the first question that I forgot to click on. That's what I was looking for when I was doing that. But we have some other questions here. Orange Pulp says, have you ever heard of a restricted open house? Before they let you in, they ask for income information. So I haven't necessarily heard it on an open house style, but I mean, during showings, depending on the price that you're purchasing, some of these luxury properties don't want just random people coming through them. So they want to verify that, hey, you are pre-approved, that you're good to go, that you're a qualified buyer before wasting any time. That's normal. But income verification for an open house seems like a lot of work for somebody. So I'm not even sure, how legal that is if it's an open house and available for everyone, and then you have to ask for income information. But nevertheless, no, I haven't heard of that side, but being pre-approved and all of that is completely normal when going through and making appointments. But not necessarily for open houses. I mean, open houses are typically, where everybody comes in. Josh, we kind of addressed this a little bit earlier, but Andy's asking, does geopolitical conflict affect the U.S. housing market? So we've seen how geopolitical conflict can affect the bond market, how it can affect the stock market. How does that translate into the housing market?
So really, if it doesn't impact our economy directly, so you guys probably get tired of us hearing us say this, supply and demand. So does it increase supply? Does it decrease demand? Only in so much as that conflict could spread and impact our economy in general, and buyers felt less confident or comfortable buying a home, or more sellers felt like, oh my goodness, I have to sell. So in this context, like that conflict in the Middle East is, in terms of intensity, is massive, but in terms of scope, it's relatively small. It doesn't involve a lot of people. It doesn't involve a lot of land area. So from that perspective, there's not a lot of goods being produced, natural resources coming out of that area. So I don't think this one has a great potential to impact us along those lines. But can a geopolitical event impact things? Absolutely. And you saw Ukraine and Russia doesn't really impact us here in the US, but it had a much bigger impact because of a larger land mass, more natural resources, more natural trade between those groups.
Yeah. And to add on to that, I mean, if oil gets impacted, that, causes changes in oil prices, which can directly affect inflation, which then translates into other things. So it has a trickle effect to some extent, depending on how long it lasts, the resources, everything that goes into it. But like Josh said, in this circumstance, I don't see that becoming something that is directly negatively going to impact the housing market, but there's always the potential, especially on a larger scale. This is a question that, so question one rental at a time. So we've talked to Mr. Zuber here on the podcast, actually, and I've talked to him here on this show before. Talks about writing disrespectful offers for properties on market over 30 days. What do I think about it? So I'm not even sure what a disrespectful offer is, but a property being on the market for 30 days isn't on the market very long, guys. I don't think people understand, when I talk about people having short memories, this is what I'm talking about. A normal market, homes are on the market for 60, 70, 90, 100 days. That's a normal market. So the fact that a home's not selling in a week or 2 weeks, 30 days is nothing. I mean, and disrespectful. I don't think writing a disrespectful offer is ever the right option, personally speaking. But again, we got to measure what disrespectful means for some people. For some people, it might be 5% if I'm a seller. For others, it might be 50% if they're a seller. So, I always write an offer based on where you think the value of that home is because of that, right? Not because you think the world's crumbling or the market's going to crash, or because, the
Global
home's
warming.
been sitting on the market. Yeah. Global warming. Oh boy. Yeah. So yeah, I don't think that's the right answer ever. But that's just me. Josh, any thoughts on that? You flip properties. You've bought distressed properties. Disrespectful offers. What does that mean to you?
It all comes down to the market. The thing I will compare, we bought in the last downturn, the first one that we bought out of the MLS was in late 2008. People hear that. And when we bought that, people were like, you're insane. Why are you buying? This market's going to go a million miles further down. And we're like, you're crazy because the discount we got on this is that big. But what I can say is throughout 2009 and most of 2010, you would write an offer that was basically an offer that you couldn't refuse as the buyer. And if the seller, the bank, didn't like it, well, there were 5 other offers out on other properties that you would equally like. So in that point, it all comes back to leverage. I didn't care if we offended them. First of all, they weren't a person. It wasn't a homeowner. So a disrespectful offer. I love Michael. I love his book. I love his philosophy. So I would have to hear exactly what he means by disrespectful. I highly doubt that in just knowing him, that in any way he would want you to truly disrespect a seller and upset them. Disrespectful meaning, hey, go in and reframe the discussion. They've set it at this high number. We're going to reframe the discussion at an absurdly low number. Now we can maybe get to a real discussion in the middle. And I would guess and think that what he's saying there is, the folks that are offended, you were never going to strike a deal with anyways. The ones that you can absolutely sort of motivate or reframe that conversation, you might be able to come to a common middle ground. But I will also say, definitely know your market. You have to know your market. I was just in Indianapolis, specifically Speedway, Indiana, over the weekend. And the market is good, but not great there. And we looked at a couple of properties. I'm like, I would like to own that property. That's a good investment. Jeb gave up on investing in Indiana, but I saw a duplex that I would have very much liked to have this weekend.
Yeah. I mean, here's what I'll say about that. The last thing I'll say about it is that, I have my house listed here in Huntington Beach. It's in escrow now. I received 4 offers, 2 of them verbal, basically told them not to write it because we were basically going in a direction. But one of them was I would consider a disrespectful offer. And in doing so, guess what? They didn't get a response. They didn't get anything. They were a cash buyer. 3 of the 4 were cash buyers, by the way. And 2 were at asking price. And 1 slightly above because of how it was structured. So, it's people like that I don't know where they're getting their thought process, their advice from in some of this stuff. But again, Josh said it best, know your market. If you're in a market that has a ton of inventory, nothing selling, okay, maybe you get a bit more aggressive. But if you're in a market where inventory is still considerably lower than it would be, normally, and things are still moving, it's not the right market for that, at least not yet. Josh, a lot of questions around refinancing. So, the question here is, if we buy a house with a 7% rate, can we refinance if the rates get back down under 4%? So in theory, bird's eye view, the answer is always yes. But what I would ask you to address in this question, because the easy answer is yes on this, but when would they not be able to refinance? What would put them in a position where they couldn't take advantage of a lower rate?
Well, this is funny. On the Vetted VA Live the other week, we actually did a deep dive and review on the loan estimate. And the last page of the loan estimate, this sounds obvious. So you look at it and you're like, why in the world would the government require us to put on your loan estimate? I should pull it up. The exact verbiage is, your ability to refinance this loan in the future is not guaranteed and will depend on the home's value, your income, and credit worthiness. So you're not planning on dropping your credit score 150 points, but it could happen. You could get hit by a truck and not have an insurance claim and be in the hospital for 12 months. Also preventing you from working. Cool. Not cool in any way, but bad things do happen. So we don't expect it to happen, but the home could drop in value. Maybe you don't have enough equity in the home. It doesn't appraise. Now, when that comes up, we always want to point out that FHA, VA, USDA have streamlined refinance options that if rates drop, no matter what happens with the value, you don't need an appraisal on the property. You can refinance that loan to current market interest rates. Fannie Mae and Freddie Mac and jumbo lenders do not have that. Fannie and Freddie, during the last downturn, the government said, hey, we didn't cut these rates and get them this low just for our health. We want people to benefit from it. So they came up with the Home Affordable Refinance Program that allowed people who were upside down to refinance. So there's always that possibility, but that was a unique response to a very unique situation that is very unlikely to recur. So absolutely, Jeb, you can do this, but you would need to qualify income and credit wise. Assets are less important when you're refinancing. Most rate and term refinances where you're just lowering your interest rate don't require assets. So income, credit, home value would be the 3 things.
All right. I got a couple questions regarding refinancing here. Sorry. Face was over the mic, not looking into it here. Regarding refinancing. So let's kind of just keep this going because it seems to be popular at the moment. Can you refinance a conventional loan into an adjustable rate, Josh?
Absolutely. There has to be a net tangible benefit. So let's say you have a 3% fixed rate and you come to me and say, hey, what's your best ARM? And I say, well, I can get you a 6-month ARM at 6.5 today. And we submit that to underwriting. The underwriter is going to go, what's the benefit? Why are they giving up a fixed at 3 for an adjustable at 6.5? There would be no benefit. So we can't do that. Now, if you say, hey, I owe $100,000 on my 3% fixed and I want $350,000 cash out. Now the benefit is I'm putting cash in my hand. And the reason why I'm doing an ARM versus another fixed is I want that lower interest rate for affordable monthly payments.
All right. Mike has a similar question, kind of addressed this for the most part, but refinancing from an approval standpoint compared to the initial loan process. For example, do you still need stable employment? So let's talk about, make this quick. Obviously, we don't have a lot of time here, but for all loans outside of what VA and FHA, you have to have income qualification. You have to have employment qualification again, credit qualification, essentially the same qualification you did initially when going through that approval process. What two loans, Josh, or maybe even three, allow you to go through that refinance process and not have that?
So FHA and VA, as part of that streamlined refinance for FHA, the interest rate reduction refinance loan for VA, they're saying, if we're putting you in a better situation, lowering your interest rate, lowering your monthly payment, and they both have different measures of how we measure that net tangible benefit, they will do it without an appraisal, and they will do it without documenting your income, assuming you have an on-time payment history. Occasionally, you could get away with a one-time 30-day late in the last 12 months. But for the most part, last 12 months are going to have to be clean. Last 24 months can't have a 60-day late, that type of stuff.
Here's what I'll say. That is the right option. Any FHA and VA, as quirky as some of the programs are and whatever, that is the right option. If you have a history of making your payments on time and you're getting a benefit by taking a lower rate, there shouldn't be this whole thing. It's crazy. Like, I was talking to my wife about it, and the idea that, hey, we're getting this now, potentially refinancing in the future, what that looks like if business is down and incomes are different, are we in a position? And she's like, well, if you're getting a lower rate, do you even have to do that? I'm like, that's the sensible approach, but have a history of being able to do that. Just my 2 cents. I thought I wanted to throw that out there.
So Jeb, did we just decide we're getting you an FHA loan to purchase your home?
We did not, because I don't think the benefits there, my friend.
Well, hold on. I have another question for you.
All right, let's hear it.
How much lower would the rate have to be on a 6-month ARM versus a 7-year ARM for you to consider it?
6 You froze.
You did too. I think our internet is acting wonderfully again. So how much lower would a 6-month ARM have to be than a 7-year ARM?
6 months. I think, I don't know. Wow. 2%. 2.
I guess you're going to stick with your 7-year. We can get it 1% lower.
Josh, 1% for 6 months. What's the cap? What's it adjust?
I'll get you all the details, and anyone else out there interested. So here's the funny thing. So having this conversation is good. Right now, I think it's a valid conversation to engage in. This product was kind of reintroduced or rolled out right at the beginning of 2022 when rates started spiking. And I know a couple of call centers that were offering this to clients saying, hey, take this, then we're going to come back and refinance you in 6 months when rates are lower and get you into a fixed rate. Those people started out, the program literally started out like 2.5%. So every 6 months it adjusts. There is a cap on it, but within like 3 adjustments, it was up over 6.5%. So in a rising rate environment, you don't want this. If you are of the belief that we are at or near a peak, you almost could write it down regardless of your ability to refinance.
It's a difference of $500 a month. So for 6 months, $3,000.
Well, that's assuming that you can refinance in 6 months.
That's what I'm saying. Yeah. For $500 savings, I don't know if $500 is worth the unknown of what happens out there in the market.
Let's say this, for most people, it's not even an option. It's not even something to consider. But for the right buyer with a big down payment, good credit, considering their options and believing that interest rates are going lower, there is a time and a place for that in the current market.
I just think not the Fed is dumb. That's not I just think there is an opportunity for them to keep things too high for too long, right? Go too far for too long, like we've talked. And could that be 8 months, another year? Could be. I don't think so, but we've been wrong, right? Before. So Anyway, conversation for another day.
Well,
So Josh,
hold on. Let's close the conversation on that. This one is the SOFR index. SOFR replaced LIBOR, and I'll go back and look at it. But if I remember, SOFR tracks Fed funds like lockstep. So you can look and say, hey, is the Fed going to cut? If the Fed's going to cut, I'm going to ride this thing lower. And if the Fed is unlikely to hike more, then I'm fairly stable and safe. So let's research it. And if any of you out there, most of you guys are interested in buying your first home, that's not an appropriate product for you. But if anyone's interested, it is a cool product that we have access to.
All right, good stuff. ZL follows up on a conversation we were having earlier, said, do you see any data to suggest climate change is affecting home buying patterns? I keep seeing this being brought up by opinionated housing experts. People are fleeing to coastal areas. Flocking to coast. I see zero impact personally. People want to live in desirable locations. Now, that said, it's not for everyone, right? There are some people that truly believe climate change is going to be a problem, in the very near future, and therefore don't want to be in these areas. I'm of the lesser belief that it's going to be a problem anytime, within my lifetime. But that's me. That's, and I haven't seen any buyer say. Now, what I will say is wildfire areas, areas that are impacted by natural disasters more so than anything else. Those are the ones that reasonable to kind of stay away, or more reasonable to stay away from, for those reasons.
Just to kind of close the loop on that, I saw a buddy from high school at an event a month or two back, and we were talking, and he sold his house right at the beginning of COVID, and they were wanting to find the right thing. So this didn't work out very well for them, but he still has all of the money from the sale of the last house and wants to get back in, but they're out in the Temecula area. He's like, anywhere that I can find a lot is in a high fire hazard area. And he's like, there's just no way. We're talking like $400 or $500 a month if you can get fire hazard insurance to build a home. So with that being said, Jeb, you're in a little bit better spot than I am. Where I am, I'm actually 1 foot below sea level. So if the sea levels start rising, I'm going to be in big trouble. But with that, I have zero plans of moving or selling my house.
Yeah. And I'm probably at pretty close to not the highest point, but pretty close to it. In Huntington. So if it gets up to my house, everybody's screwed. So except for a very small percentage of the population. Actually, the wealthiest people in Huntington will be the only people that aren't impacted because they're at the height of the highest point in the area. So let's see here. Josh, a really easy question. Are bi-weekly payments still around? And let's elaborate on that. Bi-weekly payment. Explain what it is. It sounds different than what it actually is, and what would be the benefit of it?
So biweekly, you're making a payment every 2 weeks instead of once a month. And you go, well, what's the difference? Well, if you take 20 or 52 weeks divided by 2, that's 26 half payments. So 13 full payments over the course of a year. You're basically making additional principal payments. The extra 2 weeks of reduced principal doesn't make much of a difference. It's funny, way 100 years ago, back in the 90s when I got into the business, one of the things your mailbox would get filled with is companies wanting to process this for you and charge you $20 a month to collect your check and forward it on to your lender. You can set this up with almost all of them if you want to. As rates have gone higher, I could definitely see the advantage of it. If you put it into a calculator, it's going to save you more money over the long haul, rapidly repaying a 7% mortgage versus a 3% mortgage. I still would say you're better off making sure you're maxing out all your other investments, your 401k, a Roth IRA, all that fun stuff.
Yeah, it used to save you back when rates were like 7%. I mean, again, we're back there again. I think it was like 6 or 7 years or something, making one extra payment a year. So it cuts a 30 down to a 23. I believe that's what it was. But as rates got lower, obviously less impact.
So Barry is a new homeowner. He just got into his house about 4 or 5 months ago. So hopefully, Barry, all things are going well there. And if you want to help run in the numbers, just reach out. I'll go through it with you.
Well, there you go.
Jeb, I have to ask a question here. So hold on, come back to that. Because Kel says Jeb needs to come into your office, Josh. Is only Jeb freezing, or have both of us been freezing?
I think we're both free. I mean, the internet here sucks, dude. I don't know how you run a business like this.
We don't. We're going out. We're going under.
This is a precursor as to what's happening. Rick is saying, can you elaborate on assumable loans and how they might help home sellers or home buyers? Here's what I'll do, Rick. Go over to the Educated Home Buyer, either YouTube and look at this week's video, or go to Spotify or Apple, look up the Educated Home Buyer and listen to the most recent episode. It's a 30-something minute dive into assumable loans, more information than you need to know. And it will give you everything you need. That said, Rickolas has a question. Can you briefly explain a 7-1 ARM? So a 7-1 ARM means that the payment is fixed for 7 years. So it's out of a 30-year fixed loan where the payment's fixed for 30 years. This would be fixed for 7 years, at which point it would start adjusting one time per year after that for the remainder of the loan. So it's a principal and interest payment. There's no interest only payment. It's a principal and interest, just comes with a lesser rate, comes with the idea that, you're either not going to be in the home in 7 years, or there's going to be an opportunity to refinance and fix the rate, or do something where you wouldn't have to worry about it adjusting. So, let's see, Josh, it is 5:55. So we got 63 people that have hit the thumbs up. If you haven't done so, do that. If you found any value tonight, if we answer your question, if you like listening to Josh and I, it helps. Check out the Educated Home Buyer podcast. That also helps. If you want to get in touch with myself or Josh, there's a link scrolling at the bottom of the screen. We can connect you with a real estate agent, a mortgage lender anywhere in the country. Even if you're just going through the pre-approval process, maybe you already have a lender, you're just looking for a comparison, that's a good resource to use. It doesn't cost you any money, and it's really just an opportunity to confirm that what you're getting is exactly what you think you're getting. And Orange Pulp said both are freezing, Josh. So, that creates issues.
Thought I had escaped the wrath, but
no, you've been freezing the whole time. So, Josh, where do we want to go with this? We got, this is an erroneous comment. Only thing that's evaporating is the value of the dollar. I believe the value of the dollar is actually going up. Is it not? I mean, most recent.
My bots trade it for me, Jeb. I don't actually keep track of the actual.
I made a mint of buying and selling houses the last 3 years. 1 year interest only mortgages, 3 hours north of Toronto, $100,000 per deal, made per deal. Sounds like you got it all figured out. Maybe that's why his name is Flexing. He's flexing.
Obviously is. And it's funny when you look at that, Canada makes sense, because 1 year interest only mortgage, like almost impossible to find in the US, other than high net worth borrowers with a banking relationship.
Can they get a 6-month
loans
ARM, Josh?
High net 6-month ARM. I don't know about a 6-month interest only ARM.
So Russell asked a question earlier in the show. I meant to click on it. It says, I'm thinking about selling next spring. Do you guys think the market will be higher than now? That is a difficult question. We'll say it again, market locality, where you are will dictate a lot of this. Inventory really dictates everything. I mean, if inventory goes up considerably, you could see prices pull back more, rates go down. I mean, there's so many different factors jumping all over the place that could impact this. Josh?
Let me ask it differently and see if it changes your answer. Think about selling next spring. Do you think the market will be higher than now? Thinking about selling a year from now, do you think the market will be higher than now?
I don't know. I mean, where are rates? Tell me where rates are. Tell me where inventory is, and I'll give you a better guess.
My feeling is that we are going to see a muted version of what we saw last year. The seasonality kicks in, and we could see sort of a little bit of a dip here. So if you're saying in the spring, could prices be lower? I think that's where we're more likely to see the weakness. And barring interest rates continuing to go up, we'll see strength again next spring. I shouldn't even say barring going up, assuming rates moderate a little bit. 7, 6.5, somewhere in that range, we'll continue to have appreciation through next spring and summer. But right at the beginning of the spring, if you remember, it was really like March, April before we started seeing prices tick up this year. And I wouldn't be surprised to see that again.
Yeah, I think there's a lot of people, since I started doing, kind of fill you in on the backstory of me buying a home, right? So you guys those of you who've been around, long enough on the show have heard me talk about this for the better part of 2 years, right? Kind of looking for the right opportunity. The house that we ended up buying was one that, I've been trying to buy for the better part of 4 years. And it just, he wasn't willing to sell it. Well, 2 weeks ago, Tuesday, so 2 weeks ago and one day, 15 days ago, he called me. He said, "Hey, look, I'm going to sell my house." And it was kind of like, whoa, I don't think I'm ready to do this. And then we started weighing pros and cons and thinking, I think it's the right time. I don't like the payment. There's things I don't like about it, but it's the right time in our life because of kids, because of, location and just some different things. Right. And so in having this conversation, I've been talking to other people, that have asked about it and kind of gone through the thought process. And I can't tell you how many people are kind of in a similar position. They're like, listen, I don't really want to sell my house, but if the right house came up right now, I'd probably be willing to do it. And now how many of those people actually act is another thing. But what I will say is that we were kind of in a place, we were in a really good spot where as if it didn't happen, it was okay. Like we might have been a little bummed, but it would have been fine. Could have still made it work. There was no have to do anything. And I think there's a lot of people in that position, which kind of creates an issue in and of itself, is that, with a lot of people that don't have to do something, it's just kind of like, hey, if all the stars align and everything lines up, then I'll do it. That's where you kind of get this unknown of what the market is going to do going forward. But I think there's people that are ready, that are willing and able, but just looking for the right opportunity.
Yeah, no, I'll say that, Jeb. I have a lot of buyers that I've talked to over the last 6 months that could buy right now. Just like I'm not going to. Not so much prices, it's payments. And the bigger component of that, obviously both of those play into that, but the bigger component of it is interest rates. And if we get rates at 6%, 5.5%, the majority of those people are going to be in the market because they want to own a home.
I think that's what scares me a little bit, in the sense of why would I wait for, because we've always said, hey, look, if this property came up, we would be a buyer of it because of all of the boxes that it checks for us. So it was like, if we don't act on this property now, then we probably shouldn't act on anything, because this is the one we've been talking about for the better part of 4 years, 5 years, that checked all the boxes of everything for the most part. And so it's kind of like now or never, right? You gotta be, willing to, I wouldn't say take a risk, but do some things that that aren't perfect, in order to kind of move things along. And so that's where I was. Josh, we're at 6:02. There's one question I'm just going to ask you here to end the show. It's going to be a really easy question. I don't want more than 5 words. So sum it up in 5 words.
Au revoir, Pee-wee.
No, we're not going there yet.
Oh, I jumped again.
But this is the thought, the hypothesis, the thesis of the market crashing, inventory picking up for the better part of 15 years. What do you guys think of this shadow inventory, quote unquote, shadow inventory that is supposedly out there? So you got 5 words to explain your answer to this question. What do you think? I think we should do it all like this. Like, you just get so many words.
Horseshit. How about that?
You said too much.
My favorite was when we were hearing this in 2013, when home prices had started slowly going up 2, 3, 4% a year. People were like, another leg down. The banks are holding millions of homes, just waiting for some improvement to let them go. But somehow, and it changed. Now it's the shadow inventory isn't banks holding the foreclosed properties. It's builders are just waiting and holding these properties because they don't want to flood the market. And anytime you hear someone talk about this, Jeb, they'll say, well, I drove through the new neighborhoods in my area, and I saw that they say they only have 2 houses available, but I saw that 7 of them are complete. So I know there's shadow inventory. Yet if you talk to the sales office, well, this is missing this is missing this. In Southern California, for a period of time, and I'm sure this was nationwide, there was a part on garage door openers that a lot of the builders couldn't get. So they couldn't get the certificate of occupancy without that. So there is an element of that the builders have been able to slow play their completions. You really killed
this 5-word thing, dude.
I thought we already finished that part of the game.
No, it was all like that was summarizing the show, and it was over.
You didn't want to give Jeff a good answer?
I mean, I thought the absurd horse shit was
Absurd
a good
horse shit.
answer.
Okay, we're gonna leave it at absurd horse shit and move on.
Wow. No. With that said, guys, we're going to close up the show. My 5-word answer to that is what? Let's see. It is complete nonsense. Nonsense. Is that one word or two? Anyway, yeah, nothing to worry about. But anyway, guys, we appreciate you watching. 604. Pay attention to CPI tomorrow. It could have the biggest impact of the week on rates. If you're thinking of buying,
should we do a 5:30 a.m. live and
absolutely
live
not tomorrow,
live blog, live video, the CPI release?
You could pop on there if you'd like, Josh, on the Educated Homebuyer channel. You're welcome to do it. Anyway, guys, appreciate you being here. Appreciate the support. If you haven't done so already, hit the like, hit the thumbs up, subscribe to the channel, check out the Educated Homebuyer, reach out to Josh, reach out to myself if you need us. And until next time.
You froze.